First, we are going to discuss this FX forwards and swaps, how to use FX forwards and swaps for hedging. Once we finish that, we'll move into new section. It's about fixed income securities. Probably first 2 hours or maybe 1.5 hours we may spend on this. So for that, we need some revision on the FX forwards. I hope you can remember what is FX forward transaction and what is a FX swap transactions. Today we are going to discuss how are we going to use these FX forwards and swaps to hedge our position. Any questions on FX forwards and swaps before we get into this? And we'll move into this. You can see the presentation on screen now.
Yes.
Yes. Okay, fine. So to discuss FX hedging, first we have to get the understanding about what is the foreign what sort of exposures are in the related to foreign exchange. We'll discuss about foreign exchange exposures. Then we'll discuss how do we manage foreign currency risk arising from a receipt and a payment. Then we'll discuss about how to hedge mismatches in cash flows. So FX risk, there are 3 types. First one is transaction exposure, then the translation exposure, and the last one is economic exposure. You might get through these words. When we say transaction exposure, that is the exposure that anyone can get into due to a transaction that you have entered. You have entered into a transaction which involves foreign currency, then you get the transaction exposure. So for example, exporter in Sri Lankan exporter, he may enter into a transaction with foreign party to sell something. You quote the price in, as an exporter, you quote the price in dollars or any other foreign currency. You quote the price today. Maybe based on that quote, you will get the order. Then you may have to produce goods, then deliver. It will take time. By the time you delivered goods and when you receive the cash flow, exchange rate might have moved away from the date, from the exchange rate which was there on the date that you entered into the transaction. Say you entered into the transaction, agreed on the price on the price today, but you may deliver your goods in December. In this 4-5 months, exchange rate may move. It may be in your favor or it may be against you. So that type of risk exposure, we call it transaction exposure. Because of a transaction that you have entered into, you get the exposure to exchange rate risk. This is we called a transaction exposure. So that's why it says if the exchange rate moves before the settlement, that means before you get the cash flow, exchange rate may moves, then you either make a loss or a profit. So we don't mind about making profits, but it may be a loss as well. So most of the time that transaction exposure includes with the obligations for the purchase or sales of goods, or it may be a service, but at a previously agreed price. Then you face that problem. Or it may be a borrowing or lending as well. Say you entered into a transaction to borrow $1 million today. You may get the cash flow in 1 week's time. During that time, exchange rate may vary. You may want to convert that dollars into rupees. What is the amount in terms of rupee that you get? Not only that, if you have a borrowing, then maybe after, say it's a one year borrowing, what would happen after 1 year's time? You have to pay it back. Today you borrowed $1 million. The exchange rate is 185 rupees. But in 1 year's time, when you try to pay it back, exchange rate may be 200 rupees. To buy dollars to pay the loan you're borrowing, you need more rupees. So that is also transaction exposure. Because of a borrowing, it may be a lending, you may lend it in foreign currency, but when you get it back, exchange rate might have moved away or against you. So therefore, due to any transaction in foreign exchange or with foreign currency involvement, that may give exposure to foreign exchange risk. That is we called transaction exposure. So this is an example. A tea exporter in Sri Lanka. So recently received an order from a buyer in Germany. Say this is an example. We export tea to Germany. Since it's a German party, the agreement is in euros. Say the value of that order is euro 5 million. Today is 12th July, but we expect to receive that 5 million euros in October. What would happen? If the euro-rupee exchange rate appreciates, what does it mean? Sorry, euro-rupee rate decreases. That means rupee appreciates. The amount of rupee the exporter received will be lower than what that exporter expects today. For example, assume today Euro LKR exchange rate is 210. How does the exporter price 1 kilo of tea? What are the factors he considers? So whatever the cost of production, maybe tea, to buy tea leaf, and electricity, other labor cost, all these costs will be considered. Then the manufacturer or the tea producer knows what is the cost for a price of 1 kilo. Then he might add a margin, but everything is in LKR. Assume it ultimately price is 400 rupees. In Sri Lankan terms, after considering all the cost and adding a profit margin, price of 1 kilo of tea is 400 rupees. But this exporter has to quote price in euros, not in rupees, because the buyer is in Germany. Now, what is the price of a 1 kilo of tea in terms of euro? How do you find it? price is 400 rupees in rupees. In euros, is 400 rupees. 1 euro equals 210 rupees. So therefore, 400 rupees equal to 400 divided by 210 rupees. You will get 190 or something like that. Yes. 1.9 euros. That's the price of tea in terms of euro. Price of 1 kilo of tea in terms of euro. Say the exporter knows there may be a risk, so he might not quote 190. Say he quotes it as 2 euros per 1 kilo. Then buyer agrees to buy. That's the way. This margin, everything will depends on the competitiveness in the market. How what would be the impact if he quotes 2 euros instead of 190 or 180? Everything is factored in. However, assume based on this exchange rate, the Sri Lankan exporter quotes 2 euros per 1 kilo. Now he knows based on this, for 1 euro he gets 210 rupees. But the payment will be received in October. Euros 1 kilo. Price of 1 kilo is 2 euros. Assume by October, when he receives the payment, euro LKR exchange rate is 200 for whatever reason. For whatever reason, assume by October 15th, when the tea exporter receives euros, the euro rupee exchange rate is 200. What's the problem? He calculates this price assuming that for 1 euro he will get 210 rupees. But now for each euro he gets only 200 rupees. He may not be able to recover his cost. So this is the risk. This is an example of transaction risk. Due to the transaction that the tea exporter enters into with German counterparty to sell tea at a price of 2 euros per 1 kilo of tea, based on the today's exchange rate. Once you enter into that transaction, you get the exposure to the exchange rate risk, because the delivery of goods and receipt of payments may not happen on the agreed date. There may be a time lag between when you entered into the transaction and when you get the cash flow. It doesn't matter when you deliver your goods or you receive your goods, but what matters is when you entered into the transaction and when you receive the cash flow or pay the dues, cash inflow or cash outflow. When will that happen? When it is happening in future, you're exposed to the foreign exchange risk. That sort of risk we call translation risk. Sorry, transaction risk. We call it transaction risk. The risk arising due to a transaction which involves foreign exchange. So then we'll discuss what is a translation exposure. That is arising when you have to translate your assets or liabilities in foreign currency into local currency. Let me explain that as well. Translation risk.
Sir, can you write a little below? We can't see the top. Even little below. All right.
Translation risk. Okay. Assume a Sri Lankan firm borrowed USD 1 million in June 2019. Can you see this? Sri Lankan firm borrowed $1 million in June 2019. Now, as if this is a Sri Lankan firm, as at December 31st, 2019, assuming the financial year ends in December, you prepare your financial statements. Where do you show this? In your balance sheet. No, we don't call it balance sheet. What do you call it? I think, but you prefer. You're mostly familiar with this word, balance sheet. This is a liability. In which currency you report it? As a Sri Lankan firm, you prepare your financial statements in rupees, not in dollars. Then how do you convert this 1 million into rupees? You may use the dollar LKR exchange rate as at 31st December to convert this 1 million into rupees and record it in your financial statement as a liability. Assume this is 180. End of December 2019, the exchange rate is 180, assume dollar rupee exchange rate. Then 1 million is foreign borrowing. You have only one borrowing. In liability, you may show foreign borrowing equals to 180 million. Correct? you record your borrowing in $1 million as $180 million as at 31st December 2019. Now, assume at the end of 2020, again you have to record this. Assume this is for 5 years. Then you pay back this loan in 2024. Until such time, every year in, you have to record this liability in your balance sheet. Now you have to record it December 2020 as well. What would be the exchange rate? Applicable exchange rate. It may be 185 or 170. We never know. So then, in terms of rupees, the same 1 million may be recorded as 185 million rupees. Last year your liability was 180 rupees. This year your liability is 185 rupees. Is it a gain or a loss or no impact? This is a loss. You increase your liability, that means you record some sort of loss. This is the risk that we call translation risk. It may be an asset in foreign currency or a liability in foreign currency. You have to translate into the local currency to record it in your financial statements. There are different ways of converting, not necessarily the method that I used that you have to follow. There are different ways of translating foreign currency exposures to domestic currency exposure, domestic currency into domestic currency. There are different methods. Whatever the methods you use, you will get the exposure. That is we call translation risk. So that's why it says concerned with the present measurement of past events. So the borrowing was happened in 2019 June, but still we record it. How to measure it today in terms of rupee. So that may change the value of assets, liabilities, or it may be income, or maybe your equity. These are mostly paper gains or losses because we may not realize that this is an unrealized part of the your income statement. Is it clear? Translation exposure. So then we'll move into economic exposure. When we say economic exposure, we don't want to have a transaction, current transaction which is still open, or a transaction that we have previously entered, or we may not have to have holdings into foreign currency assets, foreign currency or any foreign currency liabilities, or no foreign currency inflows, but still we have this exposure, economic exposure. So as an individual, we don't have most of the time any transaction exposure or translation exposure because we don't do any trades with foreign parties. We don't keep foreign currency assets or liabilities with us, so we don't have any translation or transaction exposures. But We all face this economic exposure. How? If the exchange rate depreciates, what would happen? Some of the imported goods, price of some of the imported goods will increase. That will have an impact on us. Inflation might increase in Sri Lanka. So that thing, we get the exposure, through that we get the exposure to the foreign exchange risk. If I go back to the previous tea exporters example, when the Euro LKR exchange rate 210, he can price 1 kilo of tea the price is €2. In this, in terms of rupees, price is 420 rupees. Say this is the price with this profit margin and everything. What would happen? This exchange rate moved to 220. Instead of 210, if price moves to 220, he may be able to price it as euro 190. Because in terms of rupees, the amount is fixed 420, considering his cost and all profit margin and everything. If the exchange rate is 210, the price in terms of euro is €2. But if the exchange rate moves to 220, same cost, so therefore price may be 190. What would happen? For the importer in Germany, he sees a reduction in price. Now it's cheap for him to buy from Sri Lanka. The competitiveness of Sri Lankan tea exporter may increase. That is economic exposure. But the same thing can happen to a Sri Lankan firm or an individual who does not have any exposure to foreign party. There may be parties or manufacturers or service providers, they are completely local. They have presence only in the domestic market. They don't import anything, they don't export anything. But still, they may face economic exposure. Or economic risk. Sometimes we heard this sort of thing. Potato, onion. What would happen if exchange rate depreciate? That means USD LKR rate increases. Sri Lankan farmers, their cost is fixed in terms of rupees. But import goods, potato, onion, any other things, what would happen? If the exchange rate depreciates, price will go up. If there's sufficient demand and supply from local, now they have the price advantage. They may be willing to sell it at a lower price. So since this exchange rate depreciate, price has gone up. Sri Lankan farmers can sell it at a higher price, but they don't export or import anything. That's the economic exposure they get. Clear? Through economic exposure, this will mainly impact the competitiveness. It may go up or may go down. In the previous tea exporter, if Euro LKR exchange rate goes down from 210 to 200, price in terms of 2 euros, now it will be 2.1 euros. So then the exporter will lose his competitiveness. He may lose some demand or some business from Germany or whatever European country. That can happen. That is the economic exposure. So in this today we are not going to discuss how to manage this economic exposure or the translation exposure. For the translation, we are not going to discuss. This is basically a business decision how to manage this. So it's out of our scope. Translation exposures, through financial instrument we can manage translation exposure, but we need some derivative instruments other than forwards. Even forward we can consider as a derivative instrument. Nowadays we consider it as a derivative instrument, but we need other derivative instruments to hedge this translation exposure. Since we haven't discussed these derivative instruments, we'll discuss how to hedge our translation exposures once we discuss derivative instruments. So therefore today we are not going to focus on economic exposure or the translation exposure, but we'll discuss how to hedge transaction exposure. When we have a payment due to a transaction, or when we have a receipt due to a transaction, we'll discuss how to hedge this. So this is the example we are going to discuss. We don't worry about the quantity, what is the amount of tea that Sri Lankan firm agrees to export, but the cash flow, what is the amount of foreign currency the Sri Lankan exporter will receive in the future. So the amount is euro 5 million. exporter agrees to sell tea and to receive euro 5 million on October 15th, 2020. What's the risk? Today, EU LKR exchange rate is 210. What is the value of euro 5 million in terms of rupees? Today, 210 into 5 million. $1 billion and 50 million rupees. That's the amount the tea exporter expects to receive at the current exchange rate. What would happen by October 15? Euro LKR rate is 200. What would happen? Then this euro 5 million would be equal to just 1 billion rupees. Is losing 50 million rupees. That's the risk the counterparty faces. But if this exchange rate increases to 210, sorry, it was 210. If it increases to 220, this amount would be 1.1 billion. He gains a 50 million rupees. Okay. Now what do you want to do? You prefer to keep this open. If 210 goes to 220, get this 1.1 billion rupees. But you don't want to do this, happen this to you. That's the general way. There are ways how to do that, but still we cannot discuss that because we haven't discussed other derivatives such as options. But if you would like to fix everything at this price, irrespective of the exchange rate on 15 October, you would like to receive certain amount which is known to you today on October 15. That can be done through a forward contract. You can fix the amount that you are going to receive in terms of rupees on a future date on the 15th through a forward contract. In this, I just wanted to explain you what is the risk. If the exchange rate, that means rupee appreciates from 200 against euro from 210 to 200, exporter will lose. But if the exchange rate rupee depreciates against euro from 200 to 220, the exporter will gain, make a profit. The risk side is if rupee appreciates. The reverse is true for an import. If rupee depreciates, he will lose because he has to pay more compared to this. If rupee appreciates 210 to 200, he has to pay less as an import. So that is one thing you have to be careful. Importer, exporter, what is the impact if domestic currency appreciates or depreciates? Importer, if domestic currency appreciates, what would happen is gain. Domestic currency appreciates means we pay less for a foreign currency. So as an importer, he prefers that, he gains. But if local currency depreciate, he is losing as an importer because importer has to pay more if domestic currency depreciates. In terms of domestic currency, importer has to pay more. The reverse is true for an exporter. For an exporter, if rupee appreciates, exporter will lose. Why? He received less amount of domestic currency, but rupee depreciate, it's a gain or a profit. Okay, I think now you have better visibility on the board. Is it true? So this is the outcome. For an importer, currency appreciation is good, but it's not good for an export. For an importer, currency depreciation is not good, but it's good for an exporter. So now think about whether you like dollar rupee to appreciate or depreciate. That means dollar rupee exchange rate to increase from 185 to 200, or you want it to go back to 150. So there are pros and cons of happening these. Think about it. So we'll go back to our original problem.
So in this example, this domestic currency mean, is it rupee? Domestic currency is rupee.
In Sri Lankan context, rupee is domestic currency, yes.
Correct.
Okay.
Thanks.
So that's why, if you remember very first day, I mentioned that if you consider about, say, Euro USD, for us, None of these are domestic. Then only we talk about base currency and counter currency. Euro is the base currency, dollar is the counter currency. But if you think about USD, JPY, dollar is the base currency, yen is the counter currency. Same thing for USD, LKR. Dollar is base currency, LKR is the counter currency. Okay, in this we are talking about an exporter, and in the future we expect some foreign currency receipt. Euro 5 million. What is the risk to the exporter? What is the risk to the exporter if Euro LKR rate goes down? That means if it goes down from 210 to 200, that's the risk. If that happens, value of this 5 million in terms of rupees would be only 1 billion, lower than what he expects as at today, based on this exchange rate. This is the risk. What he should do in a forward market, forward transaction. When he received that Euro 5 million, what he should do to get rupees? On October 15th, he receives Euro 5 million, but he needs rupees. So what should be the transaction he should do on 15th October? Exporter sells foreign currency. Exporter has to sell foreign currency, that is euro, to get rupees. He has two options. Either wait until October 15th, until he receives his cash flow in euros, and sell it to a bank and receive rupees. If he waits until that, this is the risk. This event can happen. Euro rupee exchange rate may go down and he may incur a loss. But instead, what he can do, today, he can enter into a forward sale contract. Today he can enter into a forward sale contract to do what? Sell Euro 5 million on 15th October 2020. He enters into the transaction today, but the cash flow exchange would happen on 15th October. This is the settlement date. You may remember, how do we classify a transaction, whether it's a forward or not, forward or a spot? If the trade date and the settlement date. If this is just 2 days, the difference between trade date and the settlement date, is it just 2 days, 2 business days, we call it a spot transaction. But if it is more than 2 days, beyond spot, more than 2 days, then it's a forward transaction. So today, just 12th July, we enter into a transaction to sell euros on 15th October, more than 2 days, 2 business days. So this is a forward transaction. Then the question is, at what rate this exporter will sell this euro? The bank will give a quote. So assume that is 215.75 or whatever the figure given in the presentation. How the bank derives this price? That is based on the formula that we discussed last week. $215.75. Is it clear? The exporter is going to receive foreign currency, or is having a foreign currency inflow in future. The risk is if the rupee appreciates. So avoid that. What he can do, enter into a forward transaction to sell, because he's having an inflow in future. He's having an inflow in future. To convert that inflow, foreign currency inflow, into rupees, he has to sell. He sells that and buys Sri Lankan rupees. To do that, he enter into a forward sell contract. What he is selling is this foreign currency amount. So he enter into a contract to sell euro 5 million. He has to say whether it's sell or buy, and what's the amount, what's the value date, and the price. These are the key terms of the forward contract. What are the currency pair? What is the currency pair? So what are the two currencies? And which currency is selling and which currency is buying in this? Selling euro against rupee. Sells euro, buys rupee. On when he is going to do that? On 15th October. At what rate? At 215.75, this rate. How do we derive this rate? That depends on the today's exchange rate. And say this is just about 3 months. 3-month interest rate on the euro and 3-month interest rates on the LKR. I assume you can remember the equation to calculate the forward rate. Based on that, the bank will calculate the forward rate and give a quote to the exporter. In that sense, exporter is a market taker, the bank is the market maker. Bank gives the quote. Based on that quote, exporter acts. So the exporter is the market taker, bank is the market. So this is the transaction. So what would happen? Exporter agrees to sell 5 million euro at 215.75 on October 15. Now, on October 15, what would happen? Exporter pays euro 5 million and receive 215.75 million in 115.75 into 5 million rupees. Whatever the value. It doesn't matter what would be the exchange rate. What is the exchange rate on October 15? It may be 120 or it may be Euro LKR exchange rate. It may be 220 or 200 or maybe 215. We don't care. We do the transaction based on the agreed price. Clear? We don't care about the exchange rate prevail on the date of the settlement or closer to that to settle this forward transaction. We settle the transaction based on the agreed price. None of the parties now cannot say, now the exchange rate is 200. Therefore, I should pay only 1 billion. The buyer cannot say that. Or if the exchange rate is 220, the seller cannot say, see, now the exchange rate is 220, so therefore I should receive 1.1 billion rupees. No, nobody can say like that. This is the agreement entered into. So both parties has to make the obligation. As the exporter, his obligation is to deliver 5 million euros. As the seller, as the buyer, the bank is obliged to pay the equivalent amount in rupees. This is the risk in the forward transactions, counterparty risk. Because by the time you entered into the transaction and you settle, there's a 3 month period. You never know at the end of 3 months period whether the other party will exist, or even they exist, whether they will deliver their obligations, whether they will meet their obligations. So therefore, in the forward contract, one of the risk is counterparty. That is, we have a doubt whether other party will meet its obligation on due date. That risk is there. So therefore, you don't enter into a forward contract with anyone. You have to assess the counterparty and have some idea whether this party will exist in future and on other transactions. This is just to get the idea what are the risks of forward contract. You take the counterparty risk, but what is the risk that you eliminate? You eliminate the FX risk, foreign exchange risk, especially the transaction risk. Why? Now you know what is the amount that you are going to receive as a seller of euro. You don't have any doubt what is the amount that you are going to receive. Only doubt now whether you receive that or not. That's the counterparty risk. That's why it says in financial market, there's no free lunch. There's no cost involved in that. You don't have to pay anything to the counterparty to enter into this transaction. Neither counterparty pays you anything. And some can say the difference between 210 and 215, it's the premium the bank pays to you. Why? That is just the interest rate differential. If you hold this rupee amount 210 for 3 months until October 15, what is the interest that you could have accrued on that? And the other part, if they hold euro, what is the interest they could have accrued on euro? You net it off and pay it here. Therefore, it's just a borrowing and lending, or netting effect of the borrowing and lending of one currency and the other currency. It's not a fee or something that you pay to the counterparty. No payment, no initial payments, nothing. Cash flows are exchanged only at the value date, October 15, and you don't take any risk on the exchange rate, whether the exchange rate goes up or goes down. You know what is the exact amount that you are going to receive. So you eliminate the FX risk. You eliminate FX risk, so you can be happy, but meantime you have to worry about the counterparties. You eliminate one risk and take risk in other form. That's the, you can't completely eliminate all risks. Is it clear? So then we'll move into the other side. In this example, we discuss how to hedge a foreign currency receipt. Now we'll discuss how to hedge a foreign currency payment using a forward contract. Okay, this is the result of the previous transaction. So if the exporter agrees to sell euro 5 million at 215.75, he will receive 1 billion rupees and 78 million and 750,000. So then we'll move into, is there any question on that before we move into the payment side? Okay, if not, we'll move into foreign currency payment. So this, we make a foreign currency payment when we import something. So this is an example. Sri Lankan firm of copper wire importer placed an order to buy copper wire worth of $500,000 with a Chinese supply on 15th June. The payment to the Chinese firm to be made on 15th September. So what is the risk? What is the risk that the importer, now in this instance we are talking about the importer. Most of the time what importers do, they buy foreign currency. Importer buys foreign currency. That's the action. What is the risk? So in this example, the amount is USD 500,000. He needs it on 15th September here. He has entered into the transaction on 15th June. Today is 12th July. And this is one other thing. So the underlying transaction, that means in this example, the importer buying copper, it is completely independent from this forward transaction. Only thing is the amount. Again, the amount is up to the importer or the exporter to decide. So now in this example, if you take it, the importer has entered into the transaction to buy copper on June 15th. And the value of the payment due on 15th September is 500,000. The risk is if USD LKR rate goes up, say 185 to 190. To buy $500,000, the importer has to pay more if dollar-rupee exchange rate goes up. That is the risk. That risk is there at this point, wherever. If the importer does not do any hedging transaction, the risk is there. He carries this risk until probably 13th September, because on the spot date basis, he has to enter into the transaction on 13th September to settle the transaction on 15th September spot basis. So until that time, he carries the risk. Either he can decide to carry that risk or hedge. When he should hedge it? Not necessarily on 15th June itself. If initially he might think this will go back to 180, so he's better off. If he thinks like that, he may wait. But in between that, something happens. Now his view is different. Now he is thinking this will go other way. Now he can go to a bank and ask to enter into a forward transaction. And still he might think no need to cover this whole 500,000. I'll do only for 250,000, half of it, whatever portion he decides. That can be done, but in Sri Lankan context, he cannot do any forward transaction for a value of more than $500,000 because that is his exposure. In Sri Lankan context, exporter or importer can hedge his position. Anybody can hedge his position using a forward transaction, maximum up to his full exposure, not beyond that. But partial, yes, they can do that. They can take hedge only partially and take the risk of the other portion. It is possible, and timing in between these, anywhere he can do that. But again, there are restrictions. If you enter into a transaction somewhere here, but again in somewhere August, he decide I don't want that, he cancel the trade. There are ways of cancelling, though that is discouraged. He can cancel it, but later he may not be able to enter into another transaction to do that. Just to stop speculation, there are guidelines issued by the central bank not to book a forward contract and cancel it and again rebook it. There are directions given by the central bank to that extent, but it's not our focus. Our focus here is how to hedge the position using a forward contract. Now in this example, we are considering the importer's case where importer buys foreign currency on a future date. What he can do, he can wait until 13th September and go to a bank, say, I am having a $500 worth of payment, so make a quote. Then he will buy dollars based on the exchange rate prevail on this date, maybe 186.50 or something. But he takes a risk. Maybe 186 or maybe 190 or 200 or maybe 180, 150 somewhere. So this is, the risk is if dollar LKR exchange rate goes up, that means rupee depreciates. If rupee depreciates, he needs more rupees to buy $500,000. How? He can use a forward contract to eliminate that risk. As an importer, what he should do, he may enter into a forward buy. He may enter into a forward buy transaction to buy USD 500,000 against LKR, value date September 15, 2020. Then the rate. Dollar LKR exchange rate 100. So the importer, he has to buy foreign currency on a future date. So there's a risk if dollar rupee exchange rate increases. In other terms, if rupee depreciates, he may have to pay more rupees to buy dollars. To avoid that, to fix the amount that he has to pay, to have some certainty on the transaction, he can enter into a forward transaction to buy. So basically we say when you buy something forward, forward buy. When you sell something forward, we say sell forward or forward sell. So enter into a forward buy to do what? To buy $500,000 against LKR when he is going to buy it on 15th. Settlement date is on 15th September at the rate of $LKR 190. That means for $1 he is going to buy, he has to pay 190. This is the transaction that the importer may enter into to hedge the foreign currency exposure. A transaction exposure. Then what do you do on 15th September? Importer pays how much? $500,000 into 190 rupees and receive USD 500,000. Again, this would happen irrespective of the exchange rate prevail at that date. This is the rupee amount he has to pay to buy $500,000 on 15th September. Again, whatever the exchange rate prevails on 15th September, exchange rate, it may be 185 still, or maybe 195, maybe 200, maybe 150. Whatever the exchange rate as at on 15th September, we don't worry about it, we don't care about it. Irrespective of the exchange rate, on the settlement date, the transaction is settled at the rate originally agreed, 190. Again, you take the risk of counterparty. The other party may not deliver you $500,000 on that day. That risk is there. So again, you convert or transform your exchange rate risk into a counterparty risk, credit risk. But since you can assess the counterparty, that counterparty risk is. So this is how we are going to hedge the foreign currency payment in future. Is it clear? Now we discuss how to hedge a foreign currency receipt, and in this second instance we discuss how to hedge a foreign currency payment. Any question? If not, we will move into the last one, how to use FX swaps. What is FX swap? There are two settlement dates. First leg and second leg for the far leg. First leg we also call it near leg, and far leg for the second leg. If you buy something here, what do you do? You sell same thing in the second leg. Both these activities are considered as a one transaction. We call it a buy-sell transaction. You sell one currency against another on spot basis and reverse it on a future date. Sell the bought currency and buy the sold currency. So it's a buy sell transaction. So otherwise, we sell one currency here or buy the same currency in future. That is also a single transaction with the same party. We call it a sell buy transaction. So if you buy buy USD against LKR on near leg, what do you do? In the far leg, you sell USD and buy LKR. Here you bought dollar, paying LKR, that means selling LKR. In the far leg, same amount of dollars you bought by, you sell by LKR. Generally, what do we do? The LKR amount or the counter currency amount may vary. If this is a spot transaction, we use the spot rate here, and we use the forward rate to settle. So let me put some numbers and explain you. Consider the previous exchange rate, spot rate, USD LKR, say 185. Assume this is 15th July and this is 15th September. The forward rate is 190. For this period, forward rate USD LKR is forward rate from 15th July to 15th September. Forward rate is LKR rate is 190. To make it simple, consider $1 million. You want to do a buy sell. You want to do a buy sell. So what do? You buy USD 1 million, paying 1 million into 185, LKR 185. You do it on 15th July, nearly. This is this. Buy transaction. On 15th July, you buy $1 million by paying 185 million rupees. Now what do? Meantime, you have entered into sell same $1 million on 15th September, and the applicable exchange rate is 190. The reverse is you do it here on 15th September. Sell you $1 million. You sell $1 million and receive LKR 190. This is your sell transaction. But in a buy sell shop, near leg you buy, far leg you sell. Same amount of base currency, The same amount you buy, same amount you sell, but near leg is done at spot rate generally, and the far leg is done at the forward rate. The forward rate is agreed as at on 15th July. Because on today you entered into two transactions. Into one transaction, but do two different things. But you buy today and enters into sell it in the future. That's the nature of the swap buy-sell transaction. The reverse is true for a sell-buy transaction. If it is a sell-buy, instead of buying here you sell, instead of paying you receive. Then it's a sell-buy, here you buy and pay. Then it becomes a sell-buy transaction. Depending on your requirement, you can do a buy-sell transaction or a sell-buy transaction. Whatever in this pair, what is appears first is the transaction that you do in the near leg. What appears second is the transaction that you do in the far leg. So this is the swap transaction. Now I'll explain how we can use this swap transaction in real life. Consider Sri Lankan firm manufactures something, but inputs to that I import to produce whatever the good. They import that raw materials. The company import raw materials, produce something, and sell, means export. Import raw materials, produce, and sell, export the outcome. For these imports, they may have to pay foreign currency, say dollar. For these exports, they may not pay, meaning they receive foreign currency. But you don't pay the same day and you receive the same day. There may be timing mismatch. You pay by the time that you import goods and you receive foreign currency when you sell your goods. So cash flows may occur in different time slots or different times. So what's the problem? Say again, 15th July and 15th September. On 15th July, assume there's a payment of USD 1 million. And 15th September, there's a receipt. USD 1 million. What he can do, on 15th July, the firm may receive dollars and the payment is 15th September. If possible, he may keep this $1 million for 3 months and pay it if possible. But some instance it may not be possible. What he can do, he can sell the sorry, in this is a payment. I'll reverse it. It's okay. On 15th July, what do you have to do? You have to make a payment. So then you can't keep it. No way to postpone that. You have to buy. Since it's a buy payment, you have to buy. Say today exchange rate is 185. Then there's a inflow on 15th September. Same dollar amount. But we don't know what would be the exchange rate at that point of time, 15th September. Whenever he receives that, the firm receives that $1 million on 15th September, firm can sell it. Whatever the exchange rate prevails on that time. It may be again 190 or 180 or whatever. There is a risk. Can he hedge this risk? Because there's just the timing mismatch of cash flows. You buy at 185 and in future you have to sell it, but you don't know what would be the exchange rate in future. It may be in your favor or may be against you. If it is 190, that's fine. You can sell whatever receipt at 190. You paid it at only at 185. 5 rupees per dollar you gain. But if it is other way around, you lose it. What you can do? You want to buy here, you want to sell here. So enter into a swap transaction, buy sell swap. You buy today, paying 185. Meantime, you enter into a transaction to sell in the future in 3 months time based on the forward rate. The sell transaction will be happen based on the forward rate. You can see this is as a one is spot transaction and this one is a forward transaction. So FX swap is a combination of spot and forward. Once you do this, you don't have to worry about the future exchange rate. What you need to buy dollars, you need rupees. That's it. You bridge the gap between these two cash flows. Since the first incident is payment, you buy, and the second one is a sell, you entered into a buy-sell transaction. It can be other way around. Your receipt is today, and the payment is on a future date. In that sense, this is the receipt, this is the payment. If you can keep that $1 million until this date, it's okay. But Meantime, you may need rupee to do these your activities. You have a rupee flow here, something like that. You can match it. What you have to do, since it's a receipt, what you have to do, sell in the near leg, and there's a payment on the future leg. You enter into a sell by transaction. If you have a receipt first and the payment second, enter into a sell by transaction. If you have the payment first and the receipt second, you can do buy sell transaction. That depends on your cash flow and the mismatches and which currency. Now in this example, I consider the mismatching dollars.
So we can't hear.
Mismatching rupees.
Echo is coming. We can't.
Yes, sorry. Hello. Do you have any question? I heard someone speaking. I thought there's a question. No question. Okay, is it clear how to use FX swaps to bridge the cash flow mismatches? If it is a receipt and payment,
Can't hear what you. No, sir, can't hear what you mentioned because some echo is came.
hello. If it is a receipt and payment, receipt in the near leg, payment is the far leg. What do? You do a sell by transaction. If it is a payment and receipt, then you do a buy sell transaction. That's how you can use FX swaps to bridge your cash flow mismatches in two different currencies. Is it clear? So that's the example given in the last slide. This one. In this is the example. I talk about a Sri Lankan apparel manufacturer. Very common case. They import goods from raw materials from China, and the final product may be to US or Europe. So there may be differences in time differences in cash flows, payments and receipts. If they want to hedge their exchange rate exposure, they can use a FX swap to hedge them. So if not, we'll start the new topic. It's about fixed income securities. So maybe this week and next week we'll have to spend fixed income securities. Before I go into the topic, I just remind you about the present value and future value calculations, because that is something that we need in this course. If you remember, future value equals the principal amount for the present value times 1 plus r to the n. You may remember this equation: future value, present value, r is the interest rate, n is the number of terms. Then the r should correspond with this n. Whether it's, if the r is annual, n should be annual number of years. If r is semi-annual interest rate, then the n should be number of semi-annual periods. And in this, from this equation, we can calculate the present value as, we can rewrite it as future value divided by 1 plus r n. So we may use this in the in this topic. And the other concept about the annuity payments, that means same cash flow in certain intervals for a specific period. Then what is the present value of these future cash flows? So you may remember we discussed this at the very beginning of the course. So better revise and get to know about this. At least remember the equations and the terms. Identify the terms. That is something we need in this topic. So in this topic, we are going to discuss what is a fixed income security, just an introduction about to the fixed income security, and as we did in FX, related terminology. What are the terms, specific terms that we use in the fixed income market? Then we'll move into the valuation of fixed income securities, how to find the price of a bond, fixed income security, and what are the risk and return related to fixed income securities. So these are the topics that we expect to discuss the remaining session of today and maybe the next week as well. So what is a fixed income security? As it says, fixed income as product, a fixed income security is a product, financial product, which gives you for the investor fixed cash flows. That is not generally not vary, but there are variations. First we'll discuss the basic types of fixed income securities, then we'll discuss about some variations. Generally we call them as fixed income securities just because of they have fixed cash flows. To give you an example or fixed income security which is familiar to you is the government bond. Government bond is a fixed income security. You know that every 6 months government pays a some interest to the investor. So therefore investor gets a fixed amount of cash flows according to a given schedule. So that is why we call them as fixed income securities. Debentures also are a type of fixed income security. So that's why it says fixed income security is a financial obligation of an entity that promises to pay a specified sum of money at specified future dates. So it's a financial obligation. That means some entity, in my previous example, government bonds, government is the entity, or the government is the borrower. That government promises to pay a specified sum of money, maybe 10% or something like that, every 6 months. So then every 6 months until the product it matures. That is the specified sum of money that pays in future dates. If you take a corporate debenture, that has the same features. They borrow some amount of money today as the borrower, then agrees to pay that every quarter or every semi-annual period or annually as a fixed payment. So we have different names. What is that fixed payment and what you get at the end, what you invest at the beginning. There are different terms for that. So the first one is the issuer. We call them issuer. That is, according to this definition, obligation of an entity. That becomes an obligation because that entity borrows money issuing this security. Therefore, we call them the issuer, borrower. Same thing. The entity who borrows money, we call them issuer. That issuer agrees to or promise to pay payments on regular intervals. The party agrees or promise to pay that regular payments is called the issuer. Issuer uses this product to borrow money initially. These characteristics that we use, fixed cash flow in regular intervals, there may be products, very short-term products, even a treasury bill. We can consider as a fixed income security. But generally, when we say fixed income securities, we discuss as a capital market product, long-term product. But there are some short-term products as well with these characteristics. So basically, issuer is the borrower initially who borrows funds, issuing a security which promises to pay certain or fixed amounts on future date. Basically, most of the cash flows are interest payments. At the end only, the borrower agrees to pay the borrowed or the agreed amount. We cannot say it's borrowed amount, but the agreed principal amount. So that's why it says payments at the specified dates that consist of two components: interest payments and prepayment of the amount borrowed. So this may vary based on the product. In this concept, even a loan we can consider as a fixed income security, because once you issue, say, mortgage, monthly there's a fixed installment which comprise part of interest and part of prepayment of the borrowed amounts. And the lender, the other party in this transaction, is the lender who agrees to lend money to the issuer. The party who purchased a fixed income security, we call them lenders. I think these are straightforward. Then the other one is maturity. That is the Now, the period up to which this obligation exists. So, for example, if you grant a loan 5 years, maturity is equal. It's a 5-year maturity loan. Likewise, government bonds, you know that government issued bonds with different maturities. They said in 2023 or 2027, 2045 or 2030. Likewise, so this is the basically the lifespan of the obligation. That is we call maturity. So during that number of years, the borrower or the issuer has some promised payments and other conditions to be met. The issuer has to make sure that all the conditions are met during the period. Not only payments, there may be some other conditions as well. So therefore, the maturity date of the bond refers to the date that debt will cease to exist. After the maturity date, there's no such debt that ceased by that date, maturity date. By that date, the borrower should redeem everything by paying the amount borrowed. It may be the amount borrowed or the amount agrees to pay. Then the par value. This is a very important concept in fixed income security. Say, if you grant a loan today, 1 million loan, rupees 1 million loan, the value of the loan is 1 million. So you may recover interest and capital or part of that 1 million in a monthly installment. So the par value of that loan is 1 million. But in fixed income securities, like government bonds and debentures, the amount the party borrows may not be the same as the amount the borrower agrees to pay at the end. There may be a difference. That depends on the market conditions and the investors' appetite on that product. So therefore, in bonds or the fixed income securities, par value is the amount, the principal value the borrower agrees to pay at the maturity. Or what is the amount he agrees to, the borrower agrees to pay as the principal. It may not be the amount the borrower borrows at the beginning. It may be more than that. That means more than the borrowed amount, or maybe less than the borrowed amount. But the borrower, that means the issuer in this terminology, issuer at the beginning specifically says, this is the amount that I'm going to pay back you as the capital, not the interest. What is the amount the borrower agrees to pay back as the capital? That is we call par amount. Or sometimes we call it as the principal, or the face value, redemption value, or the maturity value. Then the discount. So this relates again to the par value. So as I mentioned earlier, say government agrees to pay 1 billion in, so I think better to switch into this. Say if government issue a bond for 5 years, if you have referred to press conferences, press releases issued by Public Debt Department, you might have seen rupees 5 billion. It says face value. Or this is the par value. This is the amount the borrower, as the borrower or the issuer, government agrees to pay at the end of 5 years. This is the timeline. 5 years. This is t equals 0, 1, 2, 3, 4, 5. 5 years. The government agrees to pay 5 billion in 5 years. Payback rupees 5 billion. That is we call face value or the par value, maturity value or redemption. But government borrows money today. Issuing a bond, government effectively borrows money today. What is the amount that government borrow on a bond like this with the face value 5 billion? That amount may be less than 5 billion or maybe greater than 5 billion. The amount borrowed, yes. Borrowed amount may be less than 5 billion or greater than 5 billion or equal to 5 billion. The amount borrowed may be less than 5 billion, the face value. FE means face value. The amount borrowed may be less than 5 billion, maybe 4.85 billion, or maybe 5.12 billion, or maybe exactly 5 billion. There's a difference between face value and the amount borrowed. So when the amount borrowed is less than the face value, we call it this is at a discount. You might remember we discussed about discount in treasury bills, the same concept. Even though government agrees to pay 5 billion, investors are willing to lend today only 4.85 billion. So this is at a discount. We call this difference as the discount. But in the second instance, government agrees to pay only 5 billion in 5 years' time, but today investors agree to lend to the government more than 5 billion. That is we call premium. If the borrowed amount is less than the par value, then we say the security is trading at a discount. When the borrowed amount is higher than the par value or the face value, we call that bond is trading at a premium or issued at a premium. Then again, the trade date concept and the settlement date concept valid to fixed income securities as well. Not tradable for tradable securities, not like loans, but government securities, debentures, that sort of bonds, they are tradable. There's a secondary market. Now you know the difference between primary market and the secondary market. Even in the primary market, the trade date and the settlement date is 2 different days. In the secondary market also same concept is followed. In Sri Lankan, if you do a government security transaction today, the transaction will be settled in 2 days time. So that trade date and the time difference between trade date and settlement date, that depends on the markets. In different markets, different arrangements are there. However, as you know, trade date is the date on which the two parties come to an agreement to do the transaction. It may be a primary market transaction or it may be a secondary market transaction. If it is a primary market transaction, the agreement is between the investors and the issuer in the fixed income security markets. In the primary market, the agreement is between issuers and the investors. But if it is a secondary market, it is the agreement between two investors. One party sells the security, the other party buys the same security from another investor, not from the original issuer. And the settlement date is the date on which you exchange the cash flow and the ownership of the product or the security. So it may not happen on the same date, very rarely. Generally, there are at least 1 day or 2 day time difference depending on the market. So we have discussed enough about this trade date and settlement date. Just remember, whatever the difference between trade date and settlement date in the FX market may not be applicable for the fixed income security market. Even in the fixed income securities, in Sri Lankan context for government bonds, what is applicable may not be applicable in another country. If you take US treasuries, US government securities, they settle on T+1 basis. That means you enter into the transaction today, transaction is settled tomorrow, assuming both are business days. In some countries it may be T+2, some countries it may be T+3, and that depends on the issuer type as well. Then the coupon rate. So if we go back to this, when government issue a bond, government says face value is rupees 5 billion. Not only that, we announced one more thing. Other than maturity is announced, face value is given, and the something called coupon rate, say 10%. What is that? Coupon rate is the interest rate the issuer agrees to pay annually on the face value. This is the applicable or the agreed interest rate on the face value. This is the annual. This is an annual rate. We call it the coupon rate. What is the interest rate the issuer agrees to pay on the face value, not the amount borrowed I mentioned earlier. Face value 5 billion, amount borrowed maybe at the beginning, maybe 4.85 billion. But the interest rate is applied on the face value, not the borrowed amount. This is only at the initial stage. In the primary market, borrowed amount may be 4.85 billion. On the settlement date, investors give or lend 4.85 billion rupees to the government. Government issues the securities. Now it's electronically record keep the records of all investors, what are the amounts that they bought. That's the only relevancy of this amount, just to settle it initially in the primary market. After that, we don't worry about this. Everything will be based on this face value. 5 billion. Then the government agrees to pay 10% interest on 5 billion. Then what is the interest? What is the interest amount? Annual interest amount. $5 billion into 10%. Every year, government will pay 500 million as the interest. The interest amount paid at one period. Remember, I didn't say in a 1 year, but in one period, we call it coupon. The amount of interest paid in a single period, we call it the coupon. Coupon rate is the interest rate. It is annual, and the coupon is the amount the borrower pays as interest in a single period. Why I mention it as a period, sometimes borrower agrees to pay this interest annually. The frequency of interest payment. Anyway, frequency of interest payment in fixed income language, frequency of coupon payment. Coupon is the interest. Frequency of coupon payment may vary. It may be annual, may be semi-annual, or maybe quarterly, or maybe monthly. Again, this frequency, what is the coupon payment frequency, is agreed before the primary option takes place. In the announcement, when a party announces to the market that the party is going to borrow or issue a fixed income security, the party will announce amount, maturity, coupon rate, and coupon frequency at minimum. Sometimes this coupon rate may not announce. That depends on the type of the issuance. They decide the coupon rate based on the market demand on the issue. But what is the amount? What is the maturity? Not only that, generally the currency. And there are some other specific things, legal requirements, but generally these things has to be announced. Or the coupon rate may not announce. Sometimes coupon rate may be decided based on the market factors. So frequency that may vary from issuer to issuer, from one country to another country, even within the same country, issuer to issuer, depending on the borrowers or the issuers requirement. When it says annual, the coupon will be paid only once at the end of the year. Only once in a year, coupon payment. That is called annual. In a semi-annual coupon payment, the coupon will be paid 2 times per year. every 6 months there will be a interest payment. When it say quarterly, 4 times per year, every quarter. Monthly, that means every month there will be a interest payment. Then what is the applicable interest rate? If it is annually, applicable interest rate would be exactly the coupon rate. But if it is semi-annually, it would be coupon rate divided by 2. Quarterly, it is coupon rate divided by 4. When it comes to monthly, coupon rate divided by 12. So calculate the annual coupon amount, then divide it by 2 for 12. You will still get the same coupon amount. So coupon amounts vary, but annual coupon income would be this coupon rate at the rate of this. But coupon payment may be distributed either annually, semi-annually, quarterly or monthly, depending on the agreement that you entered into with the issuer at the very beginning. But for a particular bond, everybody gets the same frequency. Not one investor gets monthly coupon and then other investor gets semi-annual coupon. It's not. Whoever who buys security, if it is semi-annual coupon, everybody will get coupon every 6 months. And the date which the borrower paid the coupon is called coupon date. So assume first settlement date June 15, 2020. What does it mean by the first settlement date? This is the date on which the borrower receives borrowed amount. On the first settlement date, the borrower receive the amount the borrower or the issuer borrowed. The transaction, the auction might have taken place 2-3 days before this date, but this is the settlement date where investors deliver cash and receive the security. So if it is annual coupon,
so board is not clear, sir.
First coupon. Sorry?
Board is not clear. We can't see like what you write on the board. Maybe
Can't see.
can't see. Yeah. That,
See the lighting?
yeah, maybe now better.
No better. Maybe
Yeah.
darkness. So first settlement date is 15th June. Coupon frequency is annual. When do you expect to receive the first coupon? It will be 1 year after the first settlement date. First coupon will be 15th July 2021. We call that coupon date. The government or whoever who issuer will pay the coupon on 15th July 2021 if it is annual coupon. Then the second will be on again 15th July 2022. Third one on 15th July 2023. This will happen until
so it's June, right? The first
Sorry?
settlement is 15 June, right?
Sorry, this is June, then everything would be June. Sorry about it. Yes. This is 15th June, then coupon payments will be on June. Same month, same date every year. If this bond is for a 3-year maturity, on this date, you will get the coupon payment plus the face value. If the maturity is 3 years, and the coupon rate, coupon frequency is annual, the bond is settled on 15th June 2020, and you will receive 3 coupons every year on 15th June, and at the end of 3-year period, you will get the face value plus. Here you get only coupon. These are the cash flows of a general bond, but the frequency of receiving cash flows will be different based on the coupon frequency. Is it clear? What is coupon? What is coupon rate? What is coupon frequency? And what are the cash flows?
So there's small thing. Is the face value and the final settlement value both are the same, right?
What do you mean by the final settlement value?
I'm asking
What you get on the maturity date?
Yes,
What
at
do
the
you
maturity.
get when you buy?
At the maturity.
At the maturity date, yes, face value.
And the
final settlement, but still there's a difference. You
With
get
the
face value plus coupon. Then the final settlement value should be all together.
Yes, okay.
You get face value plus the coupon for the last 1-year period. If it is annual coupon. If it is a semi-annual coupon, face value plus the coupon for the last 6-month period. That would be the final settlement value. Clear? This is an example of a annual coupon bond. Every year you will get a coupon depending on the coupon rate and the face value. If we go back to our previous example, if it is 5 billion and 10%, 500 million. Every year, the issuer will pay 500 million here, 5.5 billion will be paid at the end after 3 years. But at the end of first year, 500 million as the coupon. At the end of the second year, another 500 million as the coupon. At the end of the third year, since it's the maturity, 5 billion, the face value plus the coupon amount will be paid. Clear? But what would happen if this is semi-annual coupon? Semi-annual coupon. This is 15th June 2020. Since semi-annual, first coupon will be received after 6th month. What is that date? 15th June, 6th month. You will get it on 15th December 2020. The next coupon date would be again 15th June 2021, 15th December 2021, 15th June 2022, 15th June, sorry, 15th December 2022 and 15th December 2023. Again, since it's a 3-year bond, on this date you will get face value plus coupon. In all other payment dates, you will receive only the coupon. What would be the coupon amount? If the face value is 5 billion and coupon rate is 10%. If the face value is 5 billion, coupon rate is 10%, annual coupon is 500 million. But since this is semi-annual, you get half of it. So you will get 250 million, 250 million, 250 million, 250 million. At the end, 5 billion plus 250 million. Face value and the coupon. So now, since it's semi-annual coupon for 3 years, there are 6 cash flows. Every 6 months, there are 6 cash flows. So how many periods now we have to consider? There are 6 semi-annual periods in this bond. So that is very important. Number of periods may depend on the coupon frequency that we are going to use in future. If it is semi-annual, maturity into 2, because semi-annual. If it is quarterly, maturity period into 4 cash flows. Number of cash flows. Is it clear? If it is quarterly, there may be cash flows in between these days. September, March, September, March, September, March, there will be cash flows. But then coupon payment will be half of this, or 1/4 of the annual coupon, 500 million. So now you should be clear about coupon face value, coupon rate, coupon amount, and coupon payment dates, and you can generate the cash flows. Clear? Face value or the par value. What's the meaning of that? In maturity, period, or we just call maturity, coupon rate, coupon frequency. If you know all these, you should be able to calculate the cash flows, but to get the exact timing, you need this as. first settlement date. When was this bond is settled for the very first time? From that point onwards, you decide the other coupon date. So if you know this, you can derive coupon dates based on the first settlement date and the coupon frequency. You need these two to derive coupon dates. Then you need coupon rates and coupon frequency. Decide the coupon amount. To calculate the coupon amount, you don't want to know the first settlement date or the coupon date. Just the coupon rate and coupon frequency. You can derive the coupon amount, but coupon frequency and first settlement date. Then you can decide the coupon dates. Coupon dates and coupon amount. In combination, you can prepare the future cash flows. So remember, in the coupon rate, it says it's the nominal rate and the issuer agrees to pay each year. Irrespective of the coupon frequency, this is the rate that the issuer agrees to pay for a 1 year period. Then the coupon is the, as I explained, the amount of interest that the bondholder will receive or the issuer will pay. Coupon frequency, how many coupons per year. Therefore, the coupon amount, we can calculate the coupon amount by multiplying face value into coupon rate and to 1/f divided by the coupon face value into coupon rate divided by the coupon frequency. You can calculate the coupon rate. In my previous example, we get 250 because of 5 billion into 10% into 1/2. So I hope it's clear. Then the concept, the accrued interest. What is that accrued interest? Coupon date and a coupon date. That means, say, this is 15th December 2020, and this may be 15th June 2021, assuming a semi-annual coupon. But in the market, these fixed income securities are tradable. You can buy or sell security any amount. There may be restrictions on the amount based on the market. There may be the minimum quantity requirement. Beyond that, you can buy any amount and sell any amount, and on any date. If it is a business day, you can do the transaction, and it will settle based on the market convention. So assume after 15th December, somewhere in January 2021, say 10th January one issuer sold the security to another issuer. Sorry, not issuer. One investor, bondholder, we call them bondholder, sold that security to another party. Party A sells to party B. Whenever I say on 10th January, which date I am referring? Trade date or the settlement date? Generally, I refer to the settlement date. When I say party A sells this security to party B on 10th January, this is the settlement date. What would happen? Assume party A bought it before December 2020 or from the primary market. So on 15th December, party A would receive the coupon, but still he holds that security until this date. Then on this date, the ownership will transfer to party B. From party A to party B, ownership will be transferred. So on the next coupon date, when it comes to next coupon date, issuer what he would do, he will check who are the owners of this bond. On this date, who is the owner? So who holds this bond? Party A or party B?
Party B.
Party
B.
Because on 10th January, the ownership has been transferred from party A to party B. By 15th June 2021, when the issuer checks his record, he sees party B, not party A. What would happen? On 15th June, issuer will pay the coupon to party B for the whole period. That is the interest for the whole 6-month period. Is it fair? Because party A holds some period here. Party A holds that, has the ownership of that security for this number of days. So he should get some interest income for holding that security during this 26 days. Correct. It is 15th December to 31st December, 16 days plus 10 days, 26 days. So he should get some interest for this period. That is we call accrued interest. Accrued interest, in short form, AI, accrued interest. Whatever the interest earned from the last coupon date to a given settlement date in between two coupon dates. Because up to this, interest is paid. From this date and onwards, you accrue interest. That we call accrued interest. Is it clear? What is the amount of interest accrued on the bond from the last coupon date to that specific settlement date? So that's why it says the amount of interest accrued over a period from the last coupon payment date is called the accrued interest. In this example from 15th December to 10th January, what is the interest accrued on that bond? When you do a transaction in the secondary market, the bond buyer pays that accrued interest amount to the seller on the settlement date. You don't wait until you receive the next coupon, but you pay that on the settlement date. When you buy, you pay the accrued interest to the seller on the settlement date. So then with that, we have two more terms. That is the clean price and dirty price. In simple, dirty price equals clean price plus accrued interest. Dirty price equals clean price and accrued interest. Now you wonder what is dirty price, what is clean price, but you know what is accrued interest. What is the interest accrued up to a particular date from the last coupon date? That is accrued interest. The clean price is the price the buyer pays to the seller excluding this accrued interest part. Say you agree to buy it paying 9.9 million. That is the clean price. And on top of that, you have to pay this accrued interest. Say it is 150,000. So whatever the total, 10,050,000, that is the dirty price. Clean price is the price that you agree to pay without the accrued component to buy the price, or the same thing the seller agrees to sell, but the seller would receive the accrued interest as well. Both together we call it as dirty price. That is the relationship between dirty price, clean price and accrued interest. Clean price is the price the bond is traded in the market without considering the accrued interest component. And the other concepts are full coupon and ex coupon. You might know about in dividends. Full dividends and ex dividends, the same concepts are applicable here. Say this is coupon date 1. This is coupon date 2. The issuer may pay coupon. There are 7 days here. There are 7 days before the coupon date. Whatever the date here, we call it ex coupon date. that may be 7 days or 5 days, whatever, depending on the issuers or the terms that agree between the issuers and investors at the very beginning when the bond is issued. The issuer takes a list of investors on this date. The issuer takes the list of investors on this date and make the coupon for the bondholders on this date. Bondholders as of this date. Sorry, you can't see. Can you see now? Sorry. There are two coupon dates. Before the second coupon, whatever the coupon date, bond issuer decide, it's given in the agreement at the beginning. The coupon will be paid for the bondholders on this X coupon date. We call it X coupon date. It may be 7 days or 5 days or 14 days before the coupon date. Whoever who holds the bonds on this date, as of this date, they will get the coupon on the coupon date. So whoever who holds the bond as of X coupon date, they will receive the coupon on the coupon date. If there was any transaction taken place in between, say as of this day, party A holds this, but after some time, party A sold that to party B. On the coupon date, coupon will be received by party A, not by party B, even though he is holding the bond on the coupon, because the issuer pays the coupon based on the list of investors in their records on the X coupon date. That is X coupon. So in that sense, when you do the trades in between that, this X coupon date and the coupon date, what do? Again, you have to do the adjustment, because party A has the claim only up to this interest income. For the last 7 days, interest income should go to party B, but he won't receive it because one issuer will pay that full coupon to party A. So therefore, party A may have to pay this 7 days interest to party B at the time of this transaction. That is X coupon. Then traded flat. What would happen if the settlement date falls on a coupon date? If the trade gets settled on a coupon date, there's no accrued interest on that. So therefore, clean price equals to dirty price, no coupon. So no coupon on the bond on that date. So therefore, we call it traded flat. There's no accrued interest component in the pricing.
So what if
Sorry?
obtain, what if the particular customer obtain a loan? If he obtain a loan by giving this particular bond as a collateral, then who will get the interest rate? Either that particular bank or the financial institution, or to the customer. How it works?
What do you call is a repo transaction? When we discuss this repo transaction, I mentioned that generally, if that again, in some markets, the ownership transfer in different ways. If the ownership is fully transferred, then the coupon will be paid to the current holder. That means the reverse repo party. That means the lender, cash lender. Cash lender receives the security as the collateral. Then in the list of bondholders, the lender will be recorded as the bondholder. Then that party will receive the coupon. But it is indeed it is a claim for the borrower of cash, giving the collateral to some other party. So therefore, in that instance, lender of cash will receive the coupon on the collateral, but the lender will transfer that cash to the borrower. That is the mechanism. But in repo transactions, market practice is to try to avoid that sort of incidents as much as possible. You don't keep a collateral where a coupon date falls in between the duration of the repo transaction. Say it's a 7-day repo, but you place as collateral a bond where there's no coupon in between that 7 days. That's the market practice. But whatever the way, the real owner of the coupon is the original bond holder, not the party who takes it as a collateral. But the receipt of the collateral would, receipt of the coupon payment depends on the transfer of the ownership in different repo markets. Some they fully transfer the ownership. In some just in some systems or some markets, they just mark it as a lend or keep it as a collateral. They just note it. Then the ownership remains with the original party. That means the cash borrower. Then there's no transfer of ownership to the lender. In that, original party will receive the coupon. If not, if the ownership is transferred to the lender, then the lender will receive coupon. Then lender will transfer that coupon amount to the borrower. Is it clear?
Yes, sir, clear.
So theoretically, ownership of the coupon is to the original investor. Even though you keep it as a collateral, the coupon should flow into the original or the real investor. Okay, if it is clear, then shall we move into this bullet maturity?
So how can we able to know the frequency of a bond? Like,
okay, there's something called bond covenant. That means what are the terms and conditions of a bond. It says what is the coupon rate, what is the face value, what is the maturity, and the coupon rate as well. So when they announce a bond issuance to the market, generally all these key terms are announced, but the bond covenant is a detailed legal document that specify each and every terms and conditions applicable to that transaction. There may be a lot of restrictions on the bond issuer, maybe restrictions on the balance sheet, some risk ratios and things like that, whether they can borrow from somebody else after the issuance of this bond, whether they can issue equity. There may be a lot of constraints on the bond issuer. Everything is specified on that document. We call it bond covenants. That's the legal document. But in general, the basic terms like maturity, face value, coupon rate, coupon frequency, first settlement date is announced to the market. So, for example, for a treasury bond in Sri Lanka, Public Debt Department of the Central Bank publishes press note or the paper advertisements or notice saying what are the amounts, what are the maturities and coupon rates and the coupon frequency. But in government bonds in any country, generally it's fixed. Every bond would be semi-annual or annual. They won't change from one bond to another bond. So there are market conventions. Based on that convention, you know that what is the frequency. In Sri Lanka, all Sri Lankan government bonds denominated in rupees issued as semi-annual coupon bonds. Any other question?
So now when it comes to this report, this thing, central bank issue a regulation on haircut rule. Then
report
when it
transaction.
comes to
Yes.
haircut, yes, haircut as per the haircut rule, we need to assign securities.
Yes.
When it comes to security alignment, like we need to mark that particular security in the central bank browser. Then is it how can like central bank check whether we have marked securities accordingly? Such thing is a way of trigger to central bank.
That's I'm not quite sure what is the operational aspect. So the thing is, no, if the report transaction is fully reported to the CDS, what is the report transaction, what is the amount, then it is easy to calculate what would be the haircut. Then to check whether the adequate securities are placed.
I thought like sometime the banks might not pledge the security as directed by the central bank. In such instances, is it possibility for central bank to trigger out? I thought like, okay.
I'm not sure whether the CDS or the whoever monitors that does it. But if the repo terms of the repo contract fully available to them, it is possible. But the thing is, whether it's regulated or not, when you do a repo transaction, both parties agrees to a haircut. Both parties agree to a haircut to mitigate the risk of the cash lender. That means the reverse repo party.
Correct.
Okay. So then, if the borrower, cash borrower, does not park adequate collateral, it is the risk to the reverse repo party.
Lender,
cash lender. So he has to make sure that you got the correct amount of collateral. If not, immediately contact the counterparty and ask them to replenish securities, because it's your risk. In Sri Lankan context, that I think central bank has to come and intervene to make it more clear. Otherwise, it's the risk to the lender. So whatever, without regulation, if you have signed the GMRA, General Master Repo Agreement, it says you agreed. We need this much of haircut. So the borrower's responsibility is to place enough collateral, and meantime, lender should make sure that he has got the correct amount of collateral. Otherwise, you take the risk of the counterparty. If something goes wrong, you may lose. Okay, then there are
Okay.
different
Thank you,
terms depending on the maturities, but I'll explain the most common thing. We call it the bullet maturity. In a bullet maturity, in a bond like our Sri Lankan government bonds, and what I have explained so far, the face value is paid at the end of the contract. That means on the maturity date. There is no principal prepayment before the maturity date, not like a mortgage loan. In a mortgage loan, in monthly installment, every monthly installment, part is interest income, part is capital recovery. It's not like that. In a bullet maturity, on the maturity date only you get the par value or the face value as investors, or as the issuer you pay that only on the maturity date, not prior to that. If there's any cash flow prior to that, it's only the coupon payment, that is only the interest in payments, and the face value or the par value will be paid only on the maturity date. Those are called bullet maturity, and therefore issuer is not required to pay any principal before the maturity, and lenders or the bondholders cannot ask from the issuer to pay principal earlier than the maturity. So those type of bonds we call bullet maturity. The other types are callable bonds and puttable bonds. Callable and puttable bonds. In the callable bonds, there's a right to the issuer. In a callable bond, there's a right to the issuer to early redeem the bond. That means pay back the principal before the maturity date. But there's a schedule. According to a schedule, on that scheduled date, the issuer can recall the bond and pay back the investors. The amount that pay, again, that depends on the, as I mentioned, the covenant. In a callable bond, in the covenant, bond covenant, that means the term sheet of the transaction, it will specify at what price the bond issuer can call it, whether it's at the par value or at the market value, or market value at plus some margin, something like that. The schedule is given. Sometimes it is open. It may specify after 2 years, anytime issuer can call the bond, or it may say after 2 years, only on these days issuer can call the bond. Whatever it is, in a callable bond, just know this fact, that would be enough for you. The issuer has the right to redeem the bond before the maturity according to a pre-agreed schedule. It may be partial recall or maybe full recall. In the puttable bond, it is other way. That gives a right to the investors or the bond holders. The bond holders can say, please take this back and give our money. Again, for this one as well, there's a schedule for at least lockout period. During this lockout period, you can't do that, but after that, investors can make the claim earlier than the original maturity. So that's the other deviation. Bullet maturity, principal is paid at the on the maturity date. In a callable bond, issuer has the right to redeem it before the maturity. On a puttable bond, the buyer, investor, has the right to ask his money before the maturity. So participants in fixed income market, there are many type of issuers. Governments, even central banks sometimes issue bonds, maybe to borrow money or maybe to absorb liquidity from the market and use in the open market operations. If the central bank holdings of government securities is not enough, the central bank may issue its own bonds into the market. Then use this as an instrument to absorb and provide liquidity in the to the market or from the market. Therefore, central banks sometimes issue its own bonds. And supranational agencies like JICA, ADB, Asian Development Bank, IMF or the World Bank, BRD. In Europe, there are so many supranational agencies. Basically, when we say supranational agency, it's an agency formed as a collection of several governments or countries. So it's not owned by one country, but it's a group of countries. So that's why we call it supranational. So the credibility of these agencies may be higher than individual some countries, of member countries of that organization. In the European region, there's a European Development Bank or the European Union. When we say the bond is issued by European Union, it's the whole union, not a one country. But the bond may get a credit rating of AAA or something like that, but whereas the one member like Greece, there are no more near the AAA ratings. That can happen. So supranational agencies, they are the agencies in the world formed by collection of several countries, World Bank, ADB, like that. Then the government agencies, not like in Sri Lanka, in other countries, government agencies, they can borrow money directly. In Sri Lanka, not allowed. But in other countries, government agencies on behalf of government, they can directly borrow money from the market. They can issue bonds. Then the next one, corporations, we call them in Sri Lanka as debentures. It's a fixed income security or a bond issued by a corporate. Banks, the financial institutions. State bank can issue bonds. State governments and municipalities. Again, it's not allowed in Sri Lanka, but in other countries, say Canada, province of Ontario, they can borrow their own. Municipalities, whatever the city, municipal agency, they can borrow their own, issuing bonds. And other financial institutions, as they participate in the fixed income market as issuers. Then the same or more or less the same participants participate in the fixed income market as investors. Governments buy from the bond market. Central banks buy bonds from bond market. Mostly these governments and central banks, when they engage in reserve management activities, in some countries reserve is owned by the government and managed by the government, not the central bank. In some countries only central bank. In some countries both. In Japan, part of the reserves is owned by government and the other part is owned by the central bank, Bank of Japan. Likewise, so therefore, to make investment out of the foreign currency reserves, governments and central banks buy bonds in the market, and pension funds like in Sri Lanka, EPF, ETF, or any other private firms, EPF of private firms, they are major players in as investors in the fixed income securities market. And banks or insurance companies, they do lot of investments in fixed income securities because they collect premium and they invest it. They generate income. Through that income only they pay the compensation for the insurance. So they have to generate that money. They invest in long-term investment in fixed income security market. Banks, they do it for liquidity purposes, to keep the liquidity. Anytime you can sell government bonds and generate cash. While holding, you can earn some income, not like giving a loan. So not the 100% deposit the bank can lend to customers. They need some sort of liquid assets. So one acceptable liquid asset is government bonds. They do it for the liquidity management purposes as well as investment purposes to earn the interest income. Hedge funds, so it's not in Sri Lanka. In Sri Lanka there are unit trust, or they do invest in fixed income market, and individual investors as well, maybe but small amounts. In Sri Lanka, very rare, small amounts, but in other countries, individuals, they do manage their own funds, maybe through a investment manager, but they invest in fixed income markets as well as equity markets. Then, like in any other markets, there are intermediaries, those who support the market. Primary dealers are the major part. Primary dealers are the only party, those who can participate in the primary auction. Not everybody can participate in the primary auction, but the primary dealers. Anyone else, those who want to purchase through the primary auction, they have to go through the primary dealers. Give your intention to the primary dealer, say I would like to buy this bond at this price. Then they will collect all those orders and place that order or in the bid in a primary auction. And they facilitate the secondary market as well, because primary dealers, they are market makers. They make quotes to other parties, those who want to make investment in fixed income securities. Primary dealers, they may have their inventories. That means whatever securities they bought, they hold it. But whenever there's opportunity, they may sell and buy. They do the market maker role as well. And broker dealers, again, same. They do the intermediary part, bringing the investors and the sellers into the market. Investment banks, again, they don't do investment on behalf of them, but on behalf of their clients. And not only that, investment banks, they facilitate the issuance of bonds, the primary market. So government bonds issuance is handled by public debt department or in many countries central banks, but all other issuers that we discuss, supranational government agencies, corporations, banks, or state banks, or state governments or municipalities, they have to go through or use an investment bank to structure the product or make this product and market the bond in the market and find investors to do pricing and everything and maintain books. So investment bankers play a major role in the issuance. So it's an intermediary role. Then the credit rating agencies, they assign credit ratings for the issuers. They analyze the issuers' income, past and future, governance, everything. Then they assign a rating. If an entity can get a higher rating, its borrowing cost may be low, but the credit rating is low, investors know that party is riskier, then they will ask more return. Then the amount the borrower can borrow goes or becomes less. So the interest that the borrower has to pay may be high. So therefore, credit rating agencies also play a major role. But after 2018 crisis, there were some criticism on credit rating agencies because even the AAA parties have defaulted. So there are pluses and minuses of use of credit ratings issued by agencies. So I think we'll stop here before we move into how to price a bond, because if you have to discuss this, we may not have enough time to discuss before 12:30. So we'll stop here, and from next week we'll discuss about how to price a bond. And if you go through the slides, you can see these equations. These are nothing but calculation of present value of future cash flows. That's why I mentioned at the very beginning of this section, please revise your knowledge on calculation of present value and future value and annuity payments, the equations, and what is the intuition behind those equations. We need those to calculate the price of a bond. And there are some risk characteristics or risk measures that we have to calculate. Even for that, we need some knowledge on this discounting and things like that, calculation of weighted average, things like that. So therefore, get ready for those. Do a revision on how to calculate present value, future value, discounting, and calculation of weighted average, things like that. So we'll stop here. If you have any question, we have time, I can answer. If you have any question on this or the fixed income security, what we discussed so far, or fixed income security, or any other previous topic that we discussed. If you have any questions, please free to ask.
Now, when it comes to forward contracts, like the forward contract is one of mechanism where customer can use to minimize his exchange
Yes.
Like exchange rate. My question is,
not
like,
only for a customer, that can be used by a bank or any
bank.
other instrument. Okay, yes.
Yeah, bank now when it come to when it comes to take the decision whether are we going to take into a forward contract or not, what are the main factors that we need to see, like apart from the current situation, or like will you
The
please explain on that bit?
main thing is what is your risk, whether the currency
Okay,
appreciation or depreciation. Then what is the
okay,
chance of that appreciation or depreciation? Say now,
okay,
say you are a foreign currency buyer. You want to buy in the future.
yes,
Okay. Say
okay,
in 1 month's time. In 1 month's time, you want to buy dollars. Now the exchange rate
okay,
is 185. Okay.
right, right,
Now you have to have a forecast. Okay. Oh, some view. In 1 month's time, what would be the exchange rate? Would it be more than 187 or 189 or 190? What are the chances of going there? Because if you are to buy in the future, you have to pay the premium. In our market, dollar
correct,
rupee market, you have to pay the premium. That depends on the
correct,
interest rate difference. That's fine. But if you say the spot market is 185, within a month, your guess is it won't go beyond 188 spot. If it
okay,
so, would you pay in a forward 190?
no,
No, that's it. That's it.
yes,
That's the fact thing that you have to consider. If you think spot market not move beyond certain level, and if the forward rate is beyond that, you may not pay that premium. You wait um, 1 month and buy it at a lower rate, because you
lower
can
rate, yes,
earn interest on your rupee up to that point. You don't have to pay that to other party. If you enter into a forward transaction, you keep your rupees with you, you earn interest on that, but you pay that back to the other party.
okay, right,
The premium or the discount that you have to think within the time frame. What is the volatility of the market? Whether the spot market can go beyond that forward
mm,
levels that you have to
okay,
consider.
okay. And when it comes to enter into a forward transaction, the main
Mm.
thing is if we want to buy dollars at the forward, like if we need to do a payment, that means
Mm.
we need buy dollars. Now
Mm.
we get it into a transaction to it's a
Buy
buying
because
forward contract.
you want to buy
Okay,
in future.
okay,
So
okay,
because
okay,
actually you buy in the future, not today. But
okay,
what you do, you enter into a transaction to buy it on a future date. Like say like simple, you want to buy a land.
okay,
You check everything and price is okay. So what do? You give some advance
yes, yes,
and make a reservation. So I'll do this transaction in 1 week time or 2 weeks time, because you don't carry all the time cash with you when you
okay,
go to try to buy a vehicle or something like that. You make a
yes,
small advance and you make a reservation, but you do the transaction on a future date, real
future day.
transaction, the transfer of the ownership. The same thing is here. uh, I didn't mention in the class, but I mentioned like there's no upfront payment when you enter into a forward transaction, but that is true in the wholesale market in between two parties. But even now the situation is changing. If it is an individual, definitely you have to keep 100% margin now. That
Correct.
that is there. Is
Bank used to.
that is to mitigate the counterparty risk. now even in interbank market, I don't know. I don't think in Sri Lanka it's happening now, but in the global, if you enter into a forward transaction, you means maybe two major banks, still they use collaterals. One party may keep the collateral with other party depending on the market value of the forward contract. Frequently they value the contract, then definitely one party gains, one party lose. The party who lose keep collaterals with the party who gains. That is happening. That is to minimize the credit risk.
Okay. That means once we get into a forward contract, you can't reverse it. You have to execute it at the time at the agreed date.
You cannot reverse it once you enter into generally whenever you enter into a forward contract, on the maturity, what you have to do, execute it. That means pay whatever you agree, receive whatever you agree, settle the transaction on the maturity date. In between that, you can't cancel it. But some instances, yes, banks or the other party may agree to cancel depending on the market condition. Then you do a valuation on the forward contract that you have entered. One party may gain, one party may lose. Then the party who lose has to pay that amount to the party who gains and cancel the trade. There may be penalty as well. That is cancellation. That is cancellation. What I mentioned earlier, without cancelling, to minimize the credit risk in between the trade date and the settlement date, frequently they may do the valuation and keep collateral between two parties to minimize the credit risk.
Okay, that means as example, when import customer want to take a forward rate, bank come and tell bank he want to take a forward rate, then bank goes in the market and get it into a forward contract with some other bank or whatever
importer comes to a bank and buy forward, the bank will go to the interbank market and do the same transaction in the interbank market, buy forward.
Behalf of the customer, correct.
Yes. Right. Or not on behalf of the customer, just to hedge your risk. Otherwise, you get the exposure.
Correct. Right. Hedge the risk. He did.
Because now you, as the bank, now you have exposure to deliver whatever that foreign currency to the customer in future. That gives a risk to the bank.
Yeah. To minimize that, you get it into a forward contract. Yes.
The bank itself enters into a forward contract with either with another customer or with another bank.
Okay.
Then the bank keeps the margin. That's it. Bank does not take any exchange rate risk. Bank keeps the margin.
Margin on the forward premium.
On the forward, yes. Because in the interbank market, they get better rate than the customers.
Correct. Correct.
They keep the margin.
Okay. Yes, thank you, sir.
Okay. Anything else?
So what is the main difference between transaction and the translation cost?
In the transaction, you have a transaction to be settled. You have to make a payment. In the translation, it's just a book entry. Say, if you hold some equity, or say like Bank of Ceylon, they have branches in India, Maldives, UK. They have invested some rupee amount, because basically rupee, but they have to convert it into sterling pound and invest that sterling pound amount in UK when they establish the UK branch. Say it's 1 million UK pounds, but in Sri Lankan head office accounts, that investment has to be recorded in rupee terms. How do you convert that capital, 1 million sterling pounds, in your books as at today? Can you record it at the historical rates? You can't. You have to revalue that 1 million sterling pound just to record it in your balance sheet as at today, at the today's exchange rate. It may or may give a loss or a profit. That's the translation. You don't have to make any payment in that, but the assets or liability denominated in one currency, you have to report it in another currency. Then you have to make a conversion to find out the value of the foreign currency amount in terms of domestic currency. You just use a reference rate and convert it. That is translation. In the transaction risk, you have to make a payment or you receive a payment. Then you have to convert it into local currency. Or you have to pay local currency to buy that foreign currency to make that payment. That is transaction risk.
Thank you, sir.
Okay. Anything else?
So can you ask me to share this presentation with us, because most of the people, they have not received
Presentation.
on Friday. Yeah, this PowerPoint side on Friday. This is only the link.
Only the
link,
the invitation to the class. But
yes.
in the Google Classroom, can't you see the?
Oh, that was
PDF?
there was communication, only the recording of the one of the previous lectures.
Okay. I'll inform him. But
I think they would have missed certain email addresses.
That may be because some participants has received it, but you got the invitation. Okay, we'll check. We'll check how.
Oh, okay, thank you.
Okay, thanks. Anything else? If not,
question.
Yes.
Yeah, one question. It's on this swaps. What you mentioned, like
sorry,
after the forward contract. After the forward contracts we discussed on swaps, no. When it comes to swaps deals, like banks use that also like for the same purpose where we use for hedge the risk. Is it like
yes? Bank can use it to hedge hedge their risk. Yes.
Maybe speculative.
It's a combination of forward transaction and forward transaction. So say bank buys forward, enter into a forward transaction, then the bank can enters into a sub transaction to hedge that as well.
That's like some kind of a speculative type of thing.
It's not speculative. That's hedging.
Okay.
If hedging, it is speculative, whatever the exposure that banks get, they will carry it.
Okay. Here, if you won't carry it, you
carry that, they'll do a hedging to negotiate, negate the whatever the cash flow arising from say, if you buy forward, you know in 1 month you have dollar inflow.
Okay.
The bank does not want to take that. The bank will enter into another transaction to sell dollars in 1 month.
Okay.
Then there's no dollar net inflow into the bank. They receive from one transaction and pay to the other party.
Okay. Similar way to me hedge the transaction with customer as well as banks to minimize the bank risk.
Even the bank existing position, they can use that. Yes.
Use to swap these. Right. Okay. Thank you, sir.
Okay. Anything else? If not, shall we?
And so is there any way to like we to identify the both, like is there any kind of formula like I
cannot hear you properly. Is there any way to identify
bond ISIN number? How to read the bond ISIN number? Like IC
Yes.
number in the sense like
There's a unique number called IC number. In the bond IC number, you can identify the maturity date and details.
correct. Yeah.
I'll tell you. In the
Don't talk.
in the central bank website, there's a small publication about scriptless securities.
Okay.
Scriptless securities and about the settlement system, CDS.
Okay.
So just get that in one of these. I cannot
Yes.
remember in which one.
Okay.
It is
I'll have a look on that.
the IC number. What is the breakdown? It is explained there. How to identify currency? What explains the first few numbers, and likewise it is there. Or if not, I think I have it with me. I can ask Menaka to share that one as well.
Okay. Thank you, sir.
Okay.
Thanks. Thank you very much.
Okay. Thanks. Anything else? So if not, shall we wind up, and please be prepared for the next class about the calculation of future value, present value, and annuity equation, because we need that. That's it. Okay then. Thank you very much.